You are going to try to beat the market. Millions of people do this every year. They study companies. They read earnings reports. They watch CNBC. They follow analysts. They buy the stocks they believe in. Some of them are very smart people. Some of them manage billions of dollars for a living. Harvard MBAs, Wall Street veterans, 20-person research teams. And 95% of them still lose to a simple index fund. Not occasionally. Not in bad years, consistently, over decades. This video is about why and what that means for your money. First, let's establish what we're comparing. An index fund owns everything. If you buy an S&P 500 index fund, you own a slice of the 500 largest American companies. Apple, Microsoft, Amazon, Nvidia, Johnson & Johnson. All of them, proportionally. In one purchase. You pay almost nothing in fees, as low as 0.03% per year. You don't need to decide anything. You just hold. Now, stock picking. You research individual companies. You decide which ones will outperform. You buy those. You avoid the rest. If you're right, you beat the market. If you're wrong, you don't. Sounds simple. Sounds like skill should matter. Here's the data. Every year, S&P Global publishes something called the SPIVA report. It tracks how professional fund managers perform against their benchmark index. Over 1 year, about 60% of active fund managers underperform the S&P 500. Over 5 years, that number climbs to 78%. Over 10 years, 85%. Over 20 years, 95%. The longer the time horizon, the worse active management looks. Let that land. These are not amateurs. These are professionals with access to information, tools, and research that you don't have. And after 20 years, 95 out of 100 of them still lose to an index fund. Why? There are 3 reasons, and each one is worse than the last. Reason 1. Fees. The average actively managed mutual fund charges about 1% per year. That sounds tiny. It isn't. Here is what 1% does to $10,000 over 30 years at 10% annual return. Index fund at 0.03% fees, $172,000. Active fund at 1% fees, $132,000. That 1% difference costs you $40,000 on a $10,000 investment. The fee doesn't just take 1% of your money. It takes 1% of your compounding. Every year. For 30 years. And that's assuming the fund actually matches the market, which most don't. Reason 2. Taxes. Index funds are passive. They barely trade. Active funds trade constantly. Every buy and every sell inside the fund creates a taxable event. That tax bill gets passed to you, the investor. Even in years when the fund loses money, you can still owe taxes on trades made inside it. Index funds generate almost no taxable events until you sell. You control when you get taxed. That is a structural advantage that compounds silently. Reason 3. The math of markets. This one is the most important, and almost nobody talks about it. The stock market is not a game against the house. It's a game against other investors. For every person who beats the market, someone else has to underperform it. The market return is the average of all participants combined. Before fees, half of all active investors beat the market and half don't. That's just math. It's how averages work. After fees, the average active investor must underperform, because fees are a guaranteed drag on returns that the index doesn't pay. This is not a theory. It is arithmetic. William Sharpe, Nobel Prize winner in economics, proved this in 1991. He called it the arithmetic of active management. Before costs, active managers as a group must earn exactly the market return. After costs, they must underperform. Not might. Must. So the question isn't whether most active managers will lose. They mathematically have to. The question is whether you can identify the 5% who won't in advance. Every year, some fund managers beat the market. Some beat it for 2 years in a row. A smaller number beat it for 3 years, fewer for 5. When this happens, financial media declares them geniuses. Magazine covers, TV appearances, new investors pile in. Then, in year 6 or 7, the performance reverts. S&P Global tracks this. Of funds that outperform in one 5-year period, less than 25% repeat that outperformance in the next 5-year period. Past performance doesn't predict future performance, not because the managers aren't skilled, but because markets are competitive. Every edge gets competed away. The moment a strategy works, enough people use it that it stops working. Now here's what makes this even harder. Let's say you do find a fund manager who genuinely has skill. To benefit from them, you need to identify them before their good years, not after. But you can't see the good years until they've already happened. So most investors buy after the run, which means they pay peak prices for declining performance. Buy high, get average, pay fees, owe taxes. That is the actual experience of most active fund investors. Let's look at a real number. $10,000 invested in 1993. S&P 500 index fund, no trading, just hold. $240,000 by 2023. Average actively managed fund over the same period, $163,000. Difference? $77,000. On a $10,000 investment. The person in the index fund did nothing. The fund manager worked every day, had a research team, read thousands of reports, and produced $77,000 less. This is not cherry-picked. Run any 30-year period. The result is structurally similar. Now, there are legitimate counter-arguments. Let's address them honestly. Counter-argument 1. Warren Buffett beats the market. Yes, he does. Buffett is a genuine outlier and has been for 60 years. But Buffett himself has told individual investors to buy index funds. His will instructs that 90% of the money left to his wife be put in an S&P 500 index fund. The person who has beaten the market longer than almost anyone alive recommends you don't try. Counterargument 2. What about small cap stocks or international markets? The SPIVA report tracks those too. Over 20 years, active managers underperform in every single major category. U.S. large cap, U.S. small cap, international, emerging markets, bonds. There is no category where the majority of active managers win long-term. Counterargument 3. I'm smarter than the average fund manager. Maybe, but the market you're competing against includes the smartest fund managers in the world. They have faster data, better models, more experience, and 95% of them still lose. What makes you think you'll be in the 5%? This isn't about intelligence. It's about information efficiency. By the time you read about a stock, the price already reflects what you know. Markets process information faster than any individual can act on it. So what should you actually do? Option 1. Total Market Index Fund. Owns everything. Maximum diversification. Fee around 0.03%. Option 2. S&P 500 Index Fund. Owns the 500 largest U.S. companies. Also around 0.03%. Option 3. 3-fund portfolio. U.S. total market. International index. Bond index. Covers the whole world. All 3 options share 2 things: near zero fees, and no decisions required after you set it up. That second part is underrated. Every investment decision you make is a chance to be wrong. Index funds eliminate the decisions, and with them, most of the ways you can destroy your returns. Here is the strategy in full. 1. Open a brokerage account. Fidelity, Schwab, or Vanguard. 2. Buy a total market or S&P 500 index fund. 3. Set up automatic monthly contributions. 4. Do not check it every day. 5. Do not sell when the market drops. 6. Repeat for 20 to 30 years. That is the entire strategy. It will outperform 95% of professional fund managers, not because it's clever, because it's cheap, consistent, and eliminates human error. The hardest part is not the strategy. The hardest part is doing nothing when everything tells you to act. When the market drops 30%, your brain will scream, sell. Every financial commentator will have a theory about why this time is different. Your colleagues will tell you they moved to cash. All of that is noise. The S&P 500 has recovered from every single crash in its history. Every one. The investors who held through all of them made money. The ones who sold locked in losses. Here is the final number I want to leave you with. $500 a month, starting at 23, in a total market index fund. At the historical average of 10% annually, by age 55 you have $130,000. By age 60, $1,870,000. By age 65, $3,050,000. You contributed $252,000 total over 42 years. The market did the rest. Not a fund manager, not a stock pick, not a tip from a podcast, a low-cost index fund and time. That is the thing 95% of professionals cannot beat. Not because they aren't trying, because the math doesn't allow it. You now know something most people spend their whole investing life learning the hard way. The market doesn't reward effort. It rewards patience. Buy the index. Pay almost nothing. Hold